something strange is happening in the market right now. While almost every major stock bleeds red, one name refuses to bow down AMC. It's defying gravity, holding steady, and even climbing when giants like Apple, Amazon, and Google are losing billions in minutes. And now the buzz is that AMC could be liquidating the shorts, with whispers of a potential price eruption that could shake the market to its core. In today's deep dive, we'll break down what's going on behind AMC's stability, why 687 per share is being mentioned, and how the market's ongoing collapse could be fueling the next massive move in AMC's favor. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads, and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's start from the top. According to a tweet from X Market News, the U.S. market recently erased around $1.2 trillion in value. Almost every major stock was flashing red, yet AMC remained green. While the broader market was sinking, AMC was climbing by around 2% intraday and still closed up nearly 0.7%. That alone should raise eyebrows. In an environment where panic dominates, AMC's resilience is a clear signal that something unusual is happening beneath the surface. This isn't the first time we've seen such a disconnect. AMC often moves independently of the broader market, and this independence is what sets it apart. It doesn't always mean that AMC will skyrocket every time the market dips, but rather that its investor base and internal structure make it far less reactive to panic-driven sell-offs. One of the reasons often cited for this stability is that AMC belongs to an industry considered recession-proof. Even when economic conditions tighten, entertainment and moviegoing often remain surprisingly resilient. But what gives AMC an additional layer of strength is its unique shareholder base made up largely of retail investors who are holding strong. Unlike institutions that must rebalance or trim positions during turbulent times, retail investors tend to hold through the storm. That loyalty adds a layer of stability that most other stocks simply don't have. Now here's where it gets interesting. A tweet by Stefan Vikstrom highlighted that the combined market cap loss of Apple, Amazon, Google, Meta, Microsoft, and Nvidia within a couple of hours equated to $687 per AMC share. Think about that. The money that evaporated from these tech giants' valuations could, in theory, fund AMC's share price into the hundreds. It's a symbolic comparison, but it points to a deeper truth. The same institutions that short AMC often use these mega-cap tech companies as collateral for their leveraged positions. When those collaterals drop in value, it creates ripple effects. We've seen this pattern before. Institutions borrow against tech stocks like Nvidia or Netflix to maintain short positions on AMC. When tech valuations plummet, that collateral shrinks, forcing these players to cover or face margin calls. This is exactly why AMC could see explosive upside during broader market downturns. As their safety nets weaken, their short positions become unsustainable, and liquidation follows. Now, while today's market pullback might not qualify as a full-blown crash, it's a preview of what could come. In a true market-wide meltdown, the liquidation pressure on AMC shorts could send the price skyrocketing within seconds. That's why so many retail investors remain focused on AMC, because they understand the power of the collateral system and how fragile it really is. Adding fuel to this theory, Michael Burry, known for predicting the 2008 financial crisis, mentioned that AMC appears to be moving toward a bullish breakout. He pointed to a bullish divergence on the weekly chart and even hinted that GameStop GME might follow, reclaiming its 50-day moving average and triggering a strong upward rally. When analysts of that caliber start mentioning AMC and GME in the same breath, it's worth paying attention. The bigger picture here is that AMC's strength often signals cracks forming in the short seller's wall. When shorts start losing ground on one heavily shorted stock, the pressure tends to spread. If AMC forces margin calls, GME can rally alongside it and vice versa. These two tickers have always shared a kind of financial link. especially through institutional exposure and synthetic short mechanisms. Another major sign of the system under pressure is the dramatic decline in bank liquidity. A tweet from journalist Kristen Shaughnessy revealed that banks are now clinging to just $4.1 billion in the Federal Reserve's reverse repo facility. That's an enormous drop from the more than $2 trillion held there only a few years ago. Why does that matter? Because this reverse repo pool has been one of the key sources of shorting liquidity. It's where institutions park cash temporarily to use for leverage positions, including those used to short AMC. A decline to near zero levels means that the financial system's easy money is drying up. In short, the shorts are running out of fuel. And this isn't just a theory. The entire crypto market has entered liquidation mode as well. Cryptocurrencies, once used as collateral for margin and short trades, are being sold off heavily as banks scramble to raise cash. When you connect the dots, it paints a clear picture. Liquidity is evaporating across every asset class. Crypto, stocks, and even government bonds are being sold for one reason: to raise capital. The same institutions that use these assets to maintain short positions on AMC are now desperate for cash. This liquidity crunch exposes just how distressed these financial players have become. It's not just a chart movement anymore, it's financial survival. We've already seen this movie before, quite literally. Think back to what happened to Credit Suisse and Archegos. Both were caught in over-leveraged derivative trades involving AMC and GME swaps. When those trades went south, they collapsed. That's the real power of these heavily shorted stocks. When the pressure builds, it doesn't just squeeze shorts, it shakes entire institutions. The yen carry trade is another piece of the puzzle. A tweet from the account Peruvian Bull noted that a massive unwinding of the carry trade occurred right before both Bitcoin and the S&P 500 sold off sharply. The yen has long been a barometer for global liquidity, and when that trade starts to unwind, it's a clear signal that risk exposure is being reduced everywhere. Now, Citadel, one of the key players linked to AMC short positions, has heavy exposure to the yen carry trade. As that trade weakens, Citadel's liquidity position tightens, which again ties back to AMC. If Citadel's collateral shrinks, or if it faces margin stress, we could see forced covering on short positions, the very scenario that could ignite AMC's long-awaited breakout. It's all interconnected. When liquidity disappears, when tech stocks lose trillions in value, when crypto melts, and when the yen carry trade unwinds, all of those events combine to squeeze the very institutions that have kept AMC suppressed. The more they struggle for cash, the closer we get to their collapse. Adding yet another twist, GameStop has been quietly putting pressure on the system as well. Several traders have reported issues with their GME warrants. Some were not delivered properly, while others appeared as fractional positions rather than whole. One trader, known as GME Diamond Hand, shared that Chase initially sold his warrants due to what they later called a system-wide glitch. The warrants eventually reappeared in his account, but the incident raised eyebrows. Why does that matter for AMC? Because both AMC and GME operate within the same short-selling ecosystem. If there are glitches or irregularities in delivering warrants or shares, it could point to synthetic positions being reset, something that might expose just how deep the manipulation goes. These glitches could actually represent forced resets of synthetic shares. And if that's the case, it's another sign that pressure is building on the short side of the equation. Both AMC and GME are cornering the shorts, leaving them fewer escape routes by the day. So what we're witnessing isn't just a random green day in a red market. It's a slow-motion chain reaction one where institutions are losing collateral, banks are running out of liquidity, and short sellers are being cornered with no cash left to fight back. AMC isn't just surviving the storm, it's feeding off it. The very instability that's shaking the financial system is strengthening AMC's hand. And if this trend continues, the phrase AMC liquidating the shorts might soon move from speculation to reality. Because every drop in liquidity, every collateral loss, every panic-driven sell-off is one step closer to the point of no return. And when that moment hits, AMC could do what no one expects: explode upwards while the rest of the market burns. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Before ending the video, I want to say one important thing. If you have watched the video till this point, it means you are among those who are true AMC supporters. And for supporters like you, we have created a Facebook group. You'll find the link below. Join the group and become a part of our community. Also, for our community members, we have a PDF book inside the group that explains how to do stock analysis. After reading it, you will become an expert in fundamental analysis. Thank you for watching.